guys? Welcome back to another episode of Money Moves. We cover all things stocks, real estate, investing, personal finance, a little dash of politics too to keep it spicy, to help you on your wealth building journey. Today, we've got some great updates on earnings reports coming out this week.
Yep.
We've got some more PCE news, inflation data, rate cuts, and some basic real estate data that came out, which might actually reflect some cooling in the real estate market, but we'll dig into that a little bit more.
Ooh.
First and foremost, if you are new here, don't forget to hit that subscribe button. If
Welcome.
you enjoy the show, anything that we talk about, all we ask, take 60 seconds, leave a review, share what you think of the show. It means the world to us, as well as don't forget to check out millionaireMindcast.com for all the great stuff that we have available for you guys there. So, first and foremost, how was your concert?
Bottle Rock this
Bottle
weekend
Rock
was
Napa.
Fun, yeah. It was really fun. I would be a fibber to say I didn't squeeze in a couple tastings.
Did you? Where'd you go? Of course you did.
You know I did. I swung over to Titus, and then I went over to Westwood, which is at Brasswood.
So when you squeezed those in, were you dragging Alex with you, or were you
No.
like, honey, I'm going to go to the grocery store and get some snacks real quick?
She wanted to go to the first one, and then the second day, she wanted to get lunch at the place, and that one I snuck in. She got there and started walking and didn't realize what she was walking into, but she didn't complain.
That's great.
Yeah.
That's awesome. Who was your favorite out of the
lineup
event?
Oh, Offspring by far. Oddly brought up Ed Sheeran to perform a song with them. Not only guitar, but he sang with them.
Oh, I love Teddy.
Yeah, so that was pretty cool concert. The energy was good.
Weather was probably amazing.
Great. It was like 86 degrees.
Yep.
I have a wicked farmer's tan.
Nice.
It looks normal right now, but man,
with your shirt
tell
on.
you, it looks like I'm walking around with a white tee on right now around my house.
With your shirt off.
Yeah, exactly. I'm gonna have to get outside in the backyard in the pool and get that evened out.
That's great. Big shout out to all our current, past, present servicemen and women around the United States who have fought for all of our freedoms. We are big fans of all military, all of our servicemen and women, police, firefighters, the sacrifices that all of you have made, especially those that have died in the line of duty. Man, obviously we should be celebrating. I don't understand why they don't get a whole month.
Bring it up because my birthday month is in June.
Yeah, and your favorite alphabet is about to kick off their entire month of celebration, whereas it just blows my mind we still don't give our military and first responders, police, firefighters their own month. But we'll digress off of that. But we appreciate you guys.
We do.
Big shout out. And we've got some headlines just to tap in. These were all things that kind of caught my attention this week. I'm not sure if there's anything specific that caught yours. I saw that Elon Musk's X.AI raised $6 billion and is now officially valued at $24 billion after a fresh funding round. Any rumblings or whispers around thoughts of pretty much this guy just starts a company and doubles his net worth, but this dude's changing the world on so many different levels. But he obviously wanted to do this within Tesla, correct? Mm-hmm. They did not want to do it. So
Correct.
He said, I'm going to carve out doing AI in a different corporation. And what are we, 4 or 5 months later, and he's at a $24 billion valuation on this AI company already.
Yeah, I think the biggest thing he'll touch is going to be SpaceX.
Yeah.
I think that'll be that has potential to be the largest, I think, IPO ever. I just think that's a good company because that's a completely brand new territory, and it's with somebody that people would trust to be in that territory. You know what I mean? Because he's already done electric cars. He's done the Boring Company.
Yep.
Now he'll do this AI thing. So somebody that's very good at reaching into the dark and grabbing something.
Yeah.
So yeah, very interesting.
I saw that according to Business Insider, they are claiming we're in a white-collar recession. The white-collar recession means there are fewer $100,000 jobs, and women are landing them more often than men. The U.S. is in a white-collar recession, with new $100,000 job openings being the lowest since 2018, showing that women are more likely to land these coveted roles, even though they are less likely to apply. It is very interesting. I don't see there being any issues with service-based industries, with obviously the hardworking blue-collar industries and jobs that go along with those spaces. But it does seem we got a little happy and thick in the britches when it came to the amount of jobs that were out there for people sitting behind computers, playing in the tech space.
Overhiring.
And we saw a pretty significant contraction in that space through the first half of this year.
And that was a lot due to the D stuff because people had to meet diversity,
equity, and inclusion.
I know it sounds wild, but this is what happens when you do that kind of stuff. But yeah, the DEI stuff had to be hit. And so they were overhiring and they were underqualified people sometimes of all backgrounds, white, brown, black, anybody. But they were overhiring underqualified. I think I was going to say overhiring underqualified people. And so now they don't have the sales or pipeline push through to support that staffing anymore. And so we saw at the beginning of this year and the beginning of last year, massive layoffs in tech. And that's normal at the beginning of the year. We have some jobs that get trimmed up from the seasonality, and then trimming also for the balance sheet so they can have good earnings and stuff like that. But to the point of DEI, that was one of the thorns in the side of that was overhiring underqualified people, and then those underqualified people don't produce or push through enough to the pipeline to justify keeping them around.
Yep, makes total sense. So that'll be interesting, I think, to see how that potentially shows up in job data, initial claims.
The problem with a lot of those people is they've gotten a job with liberal arts or studying behavior, things like that. Not that behavioral studies is bad, and not that some form of liberal arts is not good, but saying they don't really have a background to do much else. So we're going to have a very big spike in, I would say, unemployment to the lower age group side. And I think those people are going to have to reinvent themselves in either some sort of trade or the gig economy, going into something like that.
Yeah.
Because what happened was we went to you don't have to have so much skills, less skill-based economy. Hey, let's hire people because we like them. Let's hire them because we want to be diverse. Let's hire them because we want to be nice. But the problem is when you do that, the quality of your product, the quality of your scale goes down, and then you don't have the opportunity to grow your business in a way that's effective. And you grow and then you cut back because you got to lay off all your employees. Then you grow and then you cut back because turnover is one of, if not the most expensive things that businesses deal with across almost their whole debit side to their business. They spend a lot of money on hiring a new person, teaching them to get to a point where they're profitable, and then once they get profitable, they got to do it all over again.
Yeah. Very interesting, and we will be paying attention to that. I don't really think that impacts too many of our listeners.
No.
But I did see that Japan's 10-year bond futures plummet to their lowest level in 7 years, signaling potential economic concerns for the country.
I don't know why. What is the focus? What is the focus on Japan all of a sudden?
Yeah, that's. I guess that was going to be my question to you. The economy of Japan
is smaller than the economy of California. So I really have I'd be like, California has a budget deficit of minus $6 billion. You don't see the stock market flipping on that.
Right.
So that's a bunch of clickbait BS. Of course, if Japan doesn't do well, if you have investments in Japan, that's not going to be good. If you have exposure to Japanese companies, that will not be good. I really don't see what the hype has been over the past 3 weeks about this Japanese stuff. I was getting tired of saying recession.
I was going to say that's why I wanted to bring it up, because it was something that I was seeing more and more of, and I was like, why do we care so much about Japan?
I love my Japanese people and friends. Shout out to Japan. You guys are awesome. I have no idea why we're talking about them from a financial standpoint. So until I hear something else, I would ignore that. Sounds like just noise.
Let's talk about the things that do matter, that are important at least to our listeners. Stock portfolios.
Let's do
their investments. What do we got coming up this week that you're paying attention to? I know we got earnings, FOMC minutes last week, and there was obviously some guidance or some sentiment around that. We saw some updates to the projected percentages of whether there's going to be a rate cut in September or not.
Yeah.
What did we learn in the last week, and what are we looking forward to this week?
Tomorrow, or today, if you're listening to the podcast, we have Salesforce is reporting, and I think that's going to be a pretty big look into the enterprise side of things. They handle, I think, 7 out of 10 CRM, client relationship management softwares, and other softwares for big enterprise companies. They do their back-end software that supports their system so that the company doesn't have to waste money on their own proprietary product. Later in the week, we have the likes of Best Buy. We have Nordstrom. We have Oh gosh, help me out. We have
You got from what we saw here was
Dell,
Costco,
Costco.
Salesforce.
Yeah, so when you see if those companies, and we've been in a trend where earnings reports have been better than analysts expected. Shocker. I feel like we've been kicking that horse for 2.5 years now. And it's because analysts keep giving these layup projections. They're not super hard. They don't have huge goals, and they're allowing the companies really now to set their own guidance. Really, hey, what's the forward guidance going to be? So a company, that's becoming more of the norm, in my opinion, of instead of leaning so much on analysts or leaning on companies to just essentially follow through with what they're saying. And then if the company's not going to give their highest expectation, they're going to say, hey, we can hit this and this is a good number and we're going to aim for here. That allows them to consistently get these beats on revenues and EPS. I don't think that's as important as Friday, which is when we're going to get our PCE number. And PCE is expected to be 0.3 actually on headline and core. And I think it's expected, that was the prior report, and that's the expected current report. And if we get any sort of lower number to that, 2.2, 0.10, minus 1, that's going to have a huge positive impact, because that 0.3 would give us a 2.8 on PCE, which is still trending down in the right direction, actually slightly up from the last report at 2.7. But that would be a huge boost to the bottom line, because one of the things on the rate cut is we're not seeing rate cuts yet, or we haven't seen rate cuts yet for all the right reasons. It's almost like it's one of those things where you can say, man, I was wrong, but I'm almost glad I was wrong in this scenario. This was a good way to be wrong. The economy has continued to push forward. It's up almost 11%. The S&P is up almost 11% year to date. And a lot of people, I think, thought we needed monetary loosening, including myself, to get to this point. But it seems that the consumer is much stronger. There's still a ton of cash on the sideline. May alone is going to probably yield us about 6% of that 11%. So if this continues to happen, will rate cuts continue to get pushed back? Yes, foregoing we have a huge negative drop in PCE. But if banks are large, and the United States is highly profitable right now at these interest rate levels. So will they come down a bit? Yes. Cuts will eventually happen, and they need to happen, because when rates are this high, it's really bad for our national debt. But if we can continue to make money, it's going to take a lot of good inflation focused data to support a cut while the market's going up like this. If it does happen as anticipated in the fall, I think it's still going to be a really big boom to the market as well, because it's going to, look at all this free, not free money, but look at the loosening of this money that we can now spend and inject back into the market. We can go do this rehab for much cheaper on our piece of real estate. We can go buy this piece of real estate because now it pencils. Yeah. We can get that loan on that property because now it pencils. Oh, okay, I can eat a 4.5% loan. I'll get out of my 2.9 or 3.2 to 4.5. It was just hard to go to 5.5 or 6. Those types of conversations start happening when that happens, and that's the flame that reignites and keeps the broiler warm, so be it the U.S. economy.
Don't you think that's going to take some time, though? I don't think that's going to happen overnight, right?
No, it's not going to.
It's going to take some time to get anywhere close to. Because what they said, the percentage of rate cut estimate in September went from 65 down to mid-40s.
47, though.
47. And obviously we got some time to get there, and that could, like you said,
the cumulative percentage is like 49-51. So it's really 50-50. And that same flip could happen. We could be here next week, and it could be 65 or 75. Yeah. That's why you don't.
It's week over week.
That's one of those. This is a good example of why when there's very sensitive data, you use it as a guide, but not as an arrow, I guess. You don't say that this is my exact pointing. But right now, it's a toss-up. I think that's what it's telling us is a toss-up, because a week ago, we could have made this argument. If we could, if it's flip-flopped, we'd be saying the opposite, right? But neither would be true or false. It's just what the data is currently saying. But I think I was telling you this earlier. If we simply just remove the shelter data, we're at or below 2%. And I know this to be a fact. If we calculated inflation data like the Eurozone does, like Europe does, we would be at or below 2%, and we would be in our cut cycle right now. The Fed has to be very careful not to be late in cutting, because you want to start cutting before you get to 2%. You want to be like, hey, I see 2% right there, and I'm going to line this cut up for that 2% landing, right? Because the whole soft landing, it's a landing. It's not like a layup. It's a landing. You have to land it. You have to stick it. And I think what we're getting a little bit dangerously close to is something I mentioned earlier in the year when we thought there was going to be way more rate cuts, but not cutting soon enough, even though the data says we shouldn't, quote unquote.
Yeah.
Because what if the data spikes down on the next report and we're at 1.9? That means that we should have cut at the last meeting. So things like that can quickly happen, especially with lagging indicators holding up the inflationary data like they are. The biggest lagging indicator we have is shelter data.
Yeah.
And so it's a huge component of that calculation. So I think once that gets caught up, back in line, when I know rents are down, rents are compressing, those numbers just are not in yet.
Yeah. Yep. Yeah, it's taken some time to get those pushed through the system, right?
But if we're 3 months lag, that would put us in what? August, September.
Yeah, right there. Now, some interesting notes that you had alluded to, right? National debt being one that is too hard to ignore. We've had lots of people talking about this, big economists, big banks, Jamie Dimon, right? You got a lot of individuals that are looking at that, seeing that, concerned about that. Obviously, that's something the Fed's paying attention to. National debt has reached $34.55 trillion. That equates to about $103,000 a person, $262,000 per household, and $477,000 per child. Household debt now has hit a record high, rising to $17.69 trillion in the first quarter of 2024, with credit card debt alone averaging about $6,300 per borrower. So are there any concerns around how what the Fed is doing ties into combating some of these issues around debt?
I think a lot of that type of stuff is affected by policy outside of the Fed's purview or scope. They don't want the national debt to be that high, and they would pick to have interest rates lower if they could, because they want to get to their mandated levels as fast as possible. But they have to keep interest rates high due to being data dependent. I think a lot of what that number is, in fact, I know a lot of what that number is influenced by is policy, what we're spending our money on, where we're spending our money at, what we're doing domestically for our energy, for example. Why are we importing so much oil? Why aren't we producing and at least putting it in our strategic oil reserve? There's all these questions, and it comes down to current policy is highly to blame for that level of debt, because those types of debt items are completely affected by Congress, Senate. So if those people can get behind and pass reasonable spending bills and measures, or direct the money into the right areas instead of sending a ton of money to a foreign country, I'm not saying we can't send any, or sending a bunch of money to Israel and then backtracking off of that, or coming up with some putting money into areas where it's not going to do anything, getting rid of people's debt when you're not saying you're getting rid of people's debt when you're not getting rid of people's debt, and you're putting it on the national debt. Those types of things have to just come to a halt, and there has to just be accountability more so across the board in areas that it matters. Yeah,
and this is a little bit of a side, and I don't know if you saw that Russian President Vladimir Putin said over the weekend that he's ready to halt the war in Ukraine with a negotiated ceasefire that recognizes the current battlefield lines, saying he's prepared to fight on in Kiev if the West decides not to respond. Obviously, there's been a lot of debt incurred with American taxpaying dollars going over to Ukraine to fight that proxy war. I also saw this over the weekend. Zelensky banned opposing political parties and will now continue to remain in office without an election because of his own declaration of martial law. This person was like, thank God we've spent over $200 billion to defend democracy in Ukraine, when now essentially they're not having free and open elections anymore.
Yeah, that's normal during wartime, but you have to ask yourself, is there a war continued to go on because somebody's trying to stay in power?
Yep.
I think in the coming years, I think a lot of people are going to be shocked about some of the stuff that we find out about Ukraine and about Mr. Zelensky.
Just about where I guess our money is going, right? Because if we're talking about this national debt, very big issue.
$200 billion is
a big deal. When you're looking at national debt being 35 essential trillion dollars, 200 billion is, a sliver of that, but it's still a lot of money that has gone over there in a relatively short period of time. Obviously, that's trickling down and impacting Americans.
Somehow just gets all spent.
It's wild.
Where do they spend it?
Now, we got Consumer Confidence Index report came out this week, and obviously we've talked about the health of our economy is really tied to you guys, to us, to the consumer, right? And we are continuously shocked at the gas left in the tank of the average American consumer. U.S. Index of Consumer Confidence rebounded after 3 straight months of declines. This rebounded up to 102 in May from a revised 97.5, the conference board said on Tuesday. So we're seeing that consumer confidence is showing to still be relatively high and strong.
Yep.
I'm curious on what your thoughts are to some of these points, because these are, again, headlines. So looking at data versus headlines and what's being said, we got to really get in and pull back the layers of the onion to understand what it is that is the truth behind the reality of some of these reports that we're reading. Or I guess some of these headlines that we're reading. It said 46% of middle-class Americans said they've dialed back or completely paused saving for the future, and 38% said they don't think they could afford an unexpected expense over $1,000. Again, this is coming out from Business Insider. We saw the percentage of credit card balances in serious delinquency, which is 90 days or more on lates, climb to its highest level since 2012. That was per the New York Fed. And then you've got other economists. What are your thoughts on Paul Dietrich? I've heard his name, but I don't know a ton. Do you know who that is?
Nope.
Okay. So he had said the U.S. economy and stock market are on a clear path to recession. The economy and the stock market have never seen anything like this in history. Everything reminds me of the dot-com bubble in 2001 to 2002. We heard Jamie Dimon come out last week and say, hey, we're not out of the woods yet on a hard landing. So it's weird, right? Because we got some pretty healthy economic reports coming out for the most part. And yet there's still this weird sentiment and concern and I guess levels of paranoia that a lot of people are saying and talking about and writing about, but the data is not showing that.
Yeah, I think what happened, I think the data is finally catching up. I think maybe people feel a little burned from the beginning of the year when the market was, showing us that we were going to have more cuts than not. And now that it's maybe pulling back on that, people are getting maybe swinging too far to the conservative side. I'm still of the opinion that, I had a 49.50 price target. That's obviously way too low for the S&P. I think 5,200 or 5,300 is too low. We might need to be around 54, 5,500 on the S&P for year end or higher. And that would be another 6-7% up from where we are right now. And that would be a great year.
We saw NASDAQ closed above 17,000 for the first time ever today.
Yeah. And that's after a couple pullbacks and testing that area a bit. So I think that if that carries through tomorrow and continues to push, like when the S&P hit 5,000, now we're at around 5,300. If that can continue to do that, that's again, right now, if you're trading against the momentum, which is the trade, I believe, that's going on right now in the market, that's really hard to bet against. The momentum is very strong in the market. Small caps are still doing very good comparative to their large cap. They're more sensitive to volatility in the market, which I think is highly due to interest rates. Is it going to go down? Is it going to go up? Because those companies are going to benefit the most when interest rates go down because they're smaller. The PE ratio across large cap, mid cap, and small cap are all really good. They're not overvalued by any means. And there's still a ton of cash on the sidelines. And so I think that's going to be our catalyst here for June to have another good month in June.
When you say a ton of cash on the sidelines for the listener,
money markets.
Yeah, what does that mean?
There's a bunch of money in money markets.
So, right, so it's people have liquid cash in accounts that
it's technically not liquid in a money market, but it's a cash equivalent.
Okay.
Yeah, because most money markets are held in mutual funds.
And when would it be considered in the market and not on the sidelines?
It is in the market in a money market fund. That's why it's money market.
Okay.
It is a market for cash and cash equivalents, short term, normally 90-day or less maturity, or even shorter, commercial paper.
So then when is it considered not on the sidelines?
when it goes into instruments that are not cash equivalents.
Okay.
So fixed income and or equities.
Got
or
it.
alternatives or commodities. Excuse me. There was 4 things there.
And when would it make sense to transition off the sidelines into those instruments?
Should have done it 11% ago. This is why timing the market's so scary and so hard to do. It would have been a good idea to do it last year. It would have been a good idea to do it 3 years ago. It's a good idea to start next week. It's a good idea to get off your hands and do it now. There's a lot of, just a good time to get into the market if you're a long-term investor. There's not really a bad time to get into the market. You can look back with very short-term hindsight and say, man, 6 months ago was the height of the market. That's when I started. But if you fast forward that 4 or 5 years, you're going to be making money and not have to worry about it. So people with short-term mindsets, stay out of the market. Please don't send the word X-ray to phone number. I don't want to talk to you. People with long-term mindsets, those are the type of people that win. Yeah. And I have multiple people, yourself, myself, lots of people that have come through the show that have really solid rates of return, multi-digit teen rates of average rates of return from doing nothing but slapping money in every month or moving money over when they get too much money in cash and just never stopping. Yeah, that's all it is. My job is to pick the quality. I do a decent job at that. I don't bat 1,000, but I bat higher than average. And that's why, that's my answer. It's a good time to get in whenever you start. Yeah. You just shouldn't stop or veer from your plan due to market volatility. Yep. Yeah. It's the worst thing. It's the biggest mistake investors do. You maybe get a little more aggressive or you pull back a tiny bit, but you never stop being in the market or pull out of the market altogether, right? Correct. You stay in. Time in the market is much better than timing the market. Absolutely. Now, if you guys want to connect with Ryan and his amazing team to talk more about that in detail, you can text the word X-ray to 844-447-1555. That's the free offering that essentially goes through your entire existing portfolio, combs through it, looks at all your fees, looks at your allocations based on your goals, right, and the risks you're trying to mitigate and or upsides you're trying to get. Those are things that you and your amazing team do for our listeners for free. So X-Ray, 844-447-1555. Now, NVIDIA has been on an absolute tear. I think it closed up 6.9% today. After an already insane run-up, its market cap is now $2.8 trillion. It's teetering on the edge of toppling over Apple, which is the most valued stock of all time. What the heck is going on with NVIDIA, and is there still more room to run with this thing? Oh, yeah. There's definitely more room. The thing that I think people are discounting too much is the fact that they think that it's at its run. It's too high now. No, this is it'll be probably another 3 to 5 years of not consistent up days. Of course not. But they have a ton more legroom, especially with the projections they gave in fall. If they hit those, which they've consistently been hitting their revenue and EPS numbers, the stock price will continue to go up from its split price, which right now is around $100-ish a share. I was just polling, most people that we've bought in that for have like somewhere between a 50 to the highest one I have is 900% rate of return on their NVIDIA position. And that is not to be expected. Those rates of return are not normal. Yeah. But that's what happens because those people, we were buying NVIDIA in the 100s back when it was not fun to do. We were buying the Metas, previously Facebook, now Metas, back in the 98s and the 110s and the 115s when people were saying it was bad. That's what you do is you buy quality and you look for opportunity. Right now, I would say the stuff that I'm looking at that I'm very interested in that's like in that era. What is Mr. Breedwell? Boeing, Starbucks. I have a feeling Pershing Square is going to announce this week they took a very large position in Starbucks. I would not be shocked on that. And Pershing Square is Mr. Bill Ackman, correct? Mr. Bill Ackman, yep. Love him or hate him, big hedge fund. Dude makes some moves. Yep. I wouldn't be surprised if they took a huge position in Starbucks. That's up their alley. Because Starbucks obviously had a pullback, poor quarter. Yeah, and Boeing is going through some stuff too. They're trading at one of their lowest levels they've ever traded at, and it's just free to think that they have like 2.5 years. Like right now, they have 2.5 years of paid for or cannot deliveries. Cancel orders. Or they can, and they're not going to have to deliver a plane, and they're going to get all the money. So, like, you just have to be patient. And these are the things people get so freaked out about red on a stock. And it's like, that's when you want to buy it. Yeah. Why would you want to buy it at $400, $500 a share where it was 7-8 months ago, which people were doing? And all those people feel like idiots right now. In a few years, they'll be fine.
Yeah.
But man, you'd
Write
feel
it
a
out.
lot better if you had that entry point now. So those are the types of companies we're looking for. And then I think that T-Mobile also is acquiring U.S. Cellular. So I would expect their
Saw that.
stock to pull back a little bit and then start doing well. Also, that'd be a big cash spend. I think $4.6 billion was the reported number.
So those are a couple that you guys are keeping a spotlight on, paying attention to. I like it. Shifting over to real estate. The market might, I don't want to say be cooling off, but it's definitely slowing down, and as by design, right? This week, the Case-Shiller National House Price Index came out. Home prices climbed to record highs for April, according to the National Association of Realtors. The median home price in April was $407,000 average across the United States. The National House Price Index, which is reported by Case-Shiller, showed that it was up 6.5% year over year in March. Inventory is at the highest level since August of 2020. So to give you an idea, we saw that, where did that inventory? It was up 2.9% week over week. Let me see if I can pull up where it was at month over month, or I'm sorry, to the 2019 levels. We are down 36.4%. So still above where, or below where it was in 2019. But that being said, we've seen an expansion of inventory pretty consistently. And this is all seasonal. It's pretty par for the course there. But that being said, as a result of some of this inventory jumping up a little bit, as we're seeing obviously rates peak out and be extremely high, more borrowers are getting used to. We're seeing more borrowers are getting used to these high rates now. That being said, housing market activity in April declined 1.9% from March, which reached a 4.14 million seasonally adjusted annual rate. And we saw that April sales of existing homes declined 1.9% from April of 2023, which they were already slowing in April of last year. So year over year, we're seeing things continue to slow down a little bit, but not at the level of which we're seeing prices really retract in a big way.
Yeah.
Home values are still holding relatively strong, very insulated, and they are still equity-wise, I think, at an all-time high for the amount of tappable equity that homeowners have in their homes, which is, for most people, the largest asset they have on their balance sheet.
Yep, it's quite a bit. And I would say my parents are in the process of selling one of their houses, and they're in a contract that's contingent with the person that has an offer on theirs.
To sell their home?
Yeah, and the person listed it like a week ago, already has one offer before it even, or is about to list it. Just somebody got an off market, and it's over asking price. But they just want to see if they put it on the market, they can get another one. So I wonder if we're going to get back into that era, and if we hear, this is what happened. It'll be opposite of last time. If we start hearing people get over asking, people are going to put their house on the market because they want money.
Yeah.
And that'll add to the inventory.
When you do see it's, even though things are overall relatively healthy with consumers, with retail sales, with people, they have less cash on hand than they had, let's say, 12, 24 months, right?
100%.
So the last big bargaining chip that most people have is the equity in their home. If they see that there's an opportunity to cash in on some of that, and they really are in a position that they need to get a little bit more liquid, that's probably going to be the chip that they cash in on, right?
I agree, and a lot of people would use it as an opportunity to relocate as well to lower cost areas like Midwest,
which we are seeing. You got a lot of the Midwest states
that moved out to Alabama not too much ago.
It's crazy to
going
see
everywhere.
How much further your dollar goes in the Midwest. When I went out to Oklahoma and I was going through, my project and that big retail center I'm buying out there, I mean, I spent less in a week out there than I did like in a day and a half, 2 days here in California.
Yeah, and you were just as happy.
I don't know if just as happy. I'll say that. Like, I love where we live.
Yeah,
there's so much less to do. There's less food. There's less activity. There's less beauty. But that being said, it's a trade-off for some people, right?
It is.
That's all we got for today's show. We will continue to keep you guys posted. Anything important on next week's reporting that we want to tee up, or?
No, we'll let the week unfold, and then we'll give it to him fresh next week.
Don't forget to check out millionaireMindcast.com. If you want to connect with Ryan and his amazing team, text the word X-Ray to 844-447-1555. If you're an accredited investor, you want to get on my deals list, I have one deal that I'm going to be raising some capital for this year that I'm really excited about. We'll be releasing more information on that a little bit later, but you can text the word deals to 844-447-15. And with that being said, keep investing in yourself and your wealth on your march to the million and beyond. Man, that's a tongue twister sometimes. We appreciate you guys tuning in. We'll see you guys next week.
Cheers, y'all.